Let's move on to the third section. Two common pitfalls in fund investment. First pitfall, buying low net asset value funds. As we know, a fund's NAV is its trading price. Newly issued funds are priced at 1 yuan per share. Older funds usually have higher NAVs, some even over 2 yuan per share. This raises the question, which type is better? With 10,000 yuan, you could buy 10,000 shares of a 1 yuan fund versus 5,000 shares of a 2 yuan fund. Does lower NAV mean better value? Let's calculate. Suppose two funds have identical strategies, portfolios, positions, and even the same fund manager. Their only difference is NAV minus Fund A at 1.5 yuan, Fund B at 1.1 yuan. With 10,000 yuan, you get 6,667 shares of Fund A or 9,191 shares of Fund B. Clearly, lower NAV funds allow more shares. Since both follow identical strategies, after 10% growth, Fund A's NAV becomes 1.65 yuan. Fund B's NAV rises to 1.21 yuan. Same 10% increase. What's the final value of both funds? Smart listeners already know, equal value. Both funds deliver identical 10% returns regardless of NAV differences. Different NAVs don't affect returns when investment approaches match. Same principle applies to losses. NAV doesn't determine performance. Therefore, fund returns have no relation to NAV levels. Don't fear high NAVs. Some investors confuse high NAV funds with overpriced stocks, fundamentally different concepts. High NAV doesn't mean holding expensive stocks. Fund companies buy stocks at low prices, sell when prices and risks rise, converting assets to cash without NAV reduction. They then reinvest in cheaper stocks, repeating the cycle, growing assets and NAV while managing risks. Therefore, fund risk has no relation to its net asset value, NAV. Second pitfall. If NAV doesn't affect returns, should we still rush to buy new funds? New funds typically have low NAVs, usually 1 yuan, but come with clear drawbacks. They have 3-month closed-end periods. Nobody can predict market conditions during this time. If the market peaks during this period, managers must still buy stocks, creating risk. New funds lack historical performance data to evaluate managers' capabilities. They also lack Morningstar ratings or statistical references. Some say buy old funds in bull markets and new ones in bear markets. This logic is flawed. The real reason old funds perform better in bull markets is their higher stock allocation. A fully invested old fund easily gains 5% when the market rises 5%, while new funds just starting allocation might only gain 0.5% with 10% stock allocation when market rises 5%. New funds need closed periods precisely for gradual position building. Redemptions could disrupt fund operations during this critical phase. Even post-closure, new funds usually maintain low allocations, 30 to 40%, while old funds typically maintain 70 to 80% allocations to capture bull market gains. In bear markets, old funds might drop 5%, with the market aggressive ones even more. New funds fall less, again due to stock allocation differences. New or old is superficial. Stock allocation percentage reveals fund essence. Allocation reflects fund style, aggressive versus conservative. High allocation equals aggressive. Low allocation equals stable. The smarter strategy. Buy aggressive funds in bull markets, stable ones in bear markets. That concludes the two common fund investment pitfalls. Next, Part 4. How to build effective fund portfolios. Many investors hold multiple funds to create balanced portfolios. This essentially seeks to diversify investment risks. But remember, diversification doesn't guarantee against losses. When one fund declines, another won't necessarily rise like a seesaw. Diversification reduces but doesn't eliminate short-term volatility. Important reminder, diversification effects diminish when investments are correlated. During market panic sell-offs, nearly all stocks suffer regardless of diversification. True diversification requires selecting uncorrelated assets for your portfolio. So, how to proceed? The author outlines 3 steps. First, determine allocation ratios among fund types, stocks versus bonds or money markets, based on your timeline and risk tolerance. Conservative investors might allocate 60% to stock funds, 40% to bonds or money markets. Aggressive investors could allocate 80% to stock funds. Second step, allocate between large cap and small cap funds after setting stock allocation. Large cap funds focus on blue chip stocks. Small cap funds target smaller companies. Small caps and large caps typically have low correlation, showing rotational market patterns ideal for diversification. Each has complementary risk return profiles. Large caps offer stable returns with moderate volatility. Small caps show higher short term volatility, but better long term growth potential. Therefore, maintain balanced allocation between large or small cap funds. Third step, establish core funds and implement rebalancing. After previous steps, we've built a fund basket. Now identify core holdings. Core funds, 1 to 3 in number, should reliably achieve investment objectives. No wild swings needed. They shouldn't be volatile dark horses, but steady performers. It primarily serves as the workhorse steadily driving portfolio growth. Ideally, core funds should constitute 70 to 80% of total assets, minimum 50%. After portfolio construction comes crucial rebalancing. Example, if your 70 to 30 stock bond ratio becomes 80 to 20 after market gains, sell stocks to buy bonds. If bear market reverses ratio to 60 to 40, sell bonds to restore 70 to 30 ratio. This counterintuitive process is rebalancing. Superficially selling winners to buy underperformers, but actually implements disciplined buy low, sell high through market cycles. Maintains portfolio stability, balancing risk and return. Historical backtesting shows rebalanced portfolios outperform significantly. Finally, long-term investing's greatest enemy is human greed. Everyone dreams of buying lows and selling highs repeatedly. This market timing strategy seems ideal, but can anyone consistently identify market tops or bottoms? Market timing requires accurate predictions, nearly impossible. What we think are peaks often keep rising, causing missed opportunities, while perceived bottoms might still decline, trapping investors. Experts advise never attempt market timing, never predict highs or lows. Wall Street wisdom: markets run on greed and fear. Frequent trading embodies both. Frequent trading increases transaction costs, eroding returns. Therefore, long term holding remains the most effective risk management strategy for fund investments, countering market timing attempts. Does this mean holding all funds indefinitely? Here's the truth: buying makes you an apprentice, selling makes you a master. Exit timing should align with your investment objectives. Example, if targeting 15% annual returns, consider exiting when achieved. This concludes our exploration of K's Fund Decoded. Let's recap key insights. 1. 2 prerequisites: use disposable money and define investment horizon. 2. Fund selection criteria: Morningstar ratings, risk return metrics, fund company reputation, and manager track record. 3. Avoid 2 pitfalls: NAV, misconceptions, and new fund hype. 4. Build diversified portfolios for long-term growth, avoiding timing attempts. Ultimately, it's about making money work for you, the wealth creation secret. Follow these methods for sustainable investment success. This concludes Fund Decoded. Find reading notes below the audio. See you tomorrow.